Right now, serious analysts like Jake Claver are laying out a simple but wild idea. If structured derivatives and smart contract-based risk management truly migrate onto XRP rails, realistic price zones stop being $5 to $10 and start being $1,000 to $10,000 plus per coin. That sounds crazy until you understand one key fact about finance. The price of almost every major asset is actually set in the derivatives market, not the spot market. In this video, we walk through how that works, why XRP is positioned at the center of this shift, what technology already exists today, and what still needs to happen before the big numbers are even possible. Before we go any further, let's make this interactive. In your mind right now, what do you think is a realistic, endgame, price range for XRP if derivatives do move on-chain in size? Under $100, $100 to $999, $1,000 to $9,999, or $10,000 plus. Drop your range in the comments and then watch through to see if your number changes by the end. Let's start by demystifying derivatives. A derivative is simply a financial contract whose value is derived from something else. A commodity, a stock, an index, or in our world, a digital asset. Futures, options, swaps, structured notes, these are all derivatives. The problem in traditional finance is that nobody can even agree on the true size of the derivatives market. Estimates run from hundreds of trillions of dollars into the quadrillions. These positions are stacked on top of one another, rehypothecated, sliced, repackaged, and in many cases poorly understood. That opacity is exactly what contributed to the 2008 crisis when mortgage-backed securities and related derivatives blew up. The idea behind bringing derivatives on-chain is that you get an always-on, transparent accounting layer where smart contracts track obligations, collateral, and risk in real time instead of burying it inside dozens of proprietary balance sheets. This is where Jake Claver's thesis comes in. He points to technologies like Codius, a smart contract platform designed to handle complex derivatives logic, and the XRP Ledger as a potential accounting mechanism for this ocean of contracts. Imagine a world where the notional risk of these derivatives is tracked on-chain, with XRP playing the role of settlement asset for margin, collateral, and final payoff flows. Now you are not talking about a niche altcoin in a small crypto sandbox. You are talking about a neutral, high-speed layer that touches a meaningful slice of the global derivatives stack. In that scenario, it becomes reasonable to discuss 4 and even 5-figure prices, not because of hopium, but because of the sheer volume of value being routed and hedged across the network. To see why derivatives matter so much for price, you need to shift how you think about markets. In any mature commodity market, the real price discovery does not happen in the physical market. It happens in the derivatives market where futures and options trade. The price of gold is not set in the jewelry shop, it is set on the derivatives exchanges. The price of wheat is not set in the grain elevator, it is set on futures markets. The same is true for oil, metals, and other major commodities. Derivatives markets become the meeting point where all the hedgers, traders, producers, and speculators come together to agree on price. Crypto is gradually moving in the same direction. Healthy, liquid, transparent derivatives, futures, options, structured products, are what ultimately anchor and refine price for the underlying asset. So how does XRP plug into this? One major bridge is Spot ETFs. Spot XRP ETFs create a regulated, transparent way for institutions and retail to hold XRP without touching exchanges directly. When these products gather assets, they pull XRP into professionally managed vehicles and simultaneously deepen liquidity. That deeper, more reliable spot liquidity is the spot leg that sophisticated traders use in derivative strategies, things like basis trades between spot and futures, volatility trades with options, and structured hedging strategies. We already see this pattern with Bitcoin. Once spot ETFs launched, ETF inflows and futures open interest began to reinforce one another. As capital flows into spot products, it naturally feeds a growing derivatives complex. For XRP, the same dynamics apply. Spot ETFs provide clean, regulated access. That attracts institutional capital. Institutional capital demands deep derivatives markets, futures listed on venues like CME, options across major exchanges, and eventually more exotic structured products. All of that activity boomerangs back into stronger price discovery for XRP itself. As ETF volumes grow, the arbitrage and basis trades between ETFs, spot markets, and futures markets grow with them, tightening spreads, improving liquidity, and making XRP more attractive as a settlement and collateral asset. This is the feedback loop. More ETF demand leads to more spot liquidity, which leads to more derivatives, which leads to more price discovery and deeper institutional involvement. On the technology side, the XRP ecosystem is not standing still. The XRP Ledger is extremely good at one thing: fast, low-cost value transfer with deterministic finality. That is perfect for simple settlement, but complex derivatives require more programmable, flexible logic. That is where the XRP LEVM sidechain and partnerships like Axelar come in. The idea is to let the ledger handle tokenization and settlement while offloading complex smart contract logic, derivatives engines, risk modules, structured payoff logic, to EVM-compatible environments connected via secure messaging. Developers can build sophisticated derivatives protocols on the EVM sidechain while still benefiting from the XRP ledger's speed and liquidity. Users never even need to know which chain they're touching. They just see a seamless interface where tokenized assets, trading engines, and derivatives all work together behind the scenes. At the institutional level, you also see the pieces assembling. Ripple is a member of ISDA, the International Swaps and Derivatives Association, which is critical because ISDA standardizes how derivatives contracts are written and enforced worldwide. Legal frameworks and standard templates matter when you are talking about trillion-dollar markets. Without them, institutions are not going all in. You also see products like XRP depositary receipts, XRPDRs, which are designed to bridge digital assets into the traditional securities infrastructure, making them eligible for handling by central clearing entities like DTCC. This gives institutions familiar wrappers and compliance structures while quietly pushing digital assets deeper into the conventional system. Then there are the exchanges and brokers aligning for the next stage. Platforms like Coinbase list XRP futures. Major derivatives venues show rising open interest in XRP contracts. CME sees billions in notional XRP futures open interest, joining the likes of Binance, Bybit, OKX, and others. On top of that, firms like Robinhood are explicitly leaning into derivatives and institutional customers, and their acquisition of Bitstamp gives them a global crypto footprint that can support sophisticated products. Commercial banks are already integrating with crypto exchanges as a service layer, letting them offer digital assets directly to customers. Each of these moves is small on its own, but they all point in the same direction. Derivatives infrastructure built around or connected to the XRP ecosystem. The first is regulatory clarity and harmonization. Global regulators need to define how tokenized derivatives are treated, how smart contracts are recognized legally, and how cross-jurisdictional activity is supervised. You see steps in this direction through clarity-focused legislation and digital asset sandboxes in major jurisdictions, but fragmentations remain. The second requirement is robust, interoperable infrastructure, blockchains and sidechains that can handle high throughput and complex contracts while integrating with legacy systems for clearing, collateral management, and custody. The third is full institutional participation. Major banks, clearinghouses, asset managers, and exchanges not just experimenting on the edges, but treating on-chain derivatives as a core part of their business. And this is where XRP's story intersects with the bigger narrative. When you list what is needed on-chain identity, KYC and AML baked into workflows, audited custody, high-speed settlement, links into regulators and policymakers around the world. You start to see why Ripple and the XRP Ledger are repeatedly in the room. Ripple teams meet with governments, central banks, and regulators on a regular basis. They sit at tables where standards are being written, connect with Tier 1 and Tier 2 financial institutions, and help design the rails of CBDCs and cross-border payment systems. That is not a meme project trajectory, that is infrastructure work. It is one of the reasons many long-term XRP holders are comfortable betting the house, not on quick flips, but on a decade-long transformation of market plumbing. So where are we right now on the path from today's crypto markets to a world where a significant chunk of derivatives trading, clearing, and collateral management runs on chains like XRPs? The honest answer is partial migration. Some crypto derivatives and tokenized representations of traditional assets already trade on-chain. Certain regions, especially in Asia-Pacific, move aggressively with innovative platforms and trillions in annual volumes in DeFi and hybrid systems. But the overwhelming majority of the 1 quadrillion plus derivatives market, especially interest rate swaps, FX swaps, and credit derivatives, still lives in traditional infrastructure. The likely path forward is gradual hybridization. More instruments are tokenized, more collateral moves on-chain, more clearing workflows integrate blockchains, and over time the line between on-chain and off-chain derivatives fades. Through all of this, XRP's role is clear: liquidity and hedging tool, institutional on-ramp, signaling mechanism for market maturity, and eventual settlement and collateral asset for derivatives built on or connected to the XRP Ledger ecosystem. As open interest and notional volumes in XRP derivatives expand, fueled by ETFs, institutional adoption, and more advanced smart contract platforms, the price of XRP is increasingly set where the big money lives: in derivatives, not just spot exchanges. That is where Jake Claver's 4- and 5-figure XRP scenarios stop sounding like pure fantasy and start sounding like a possible outcome if, and only if, a meaningful share of the derivatives world chooses this stack as its operating system. Now I want to hear from you. Having seen how price discovery really works, how ETFs and derivatives form a feedback loop, and how the XRP ecosystem is quietly building towards institutional-grade derivatives infrastructure, has your endgame price range for XRP changed at all? Are you more conservative, more aggressive, or exactly where you started? Share your updated range in the comments, and tell me why. If this breakdown helps you see beyond simple price charts and into the actual architecture that decides where value flows, make sure you stay tuned. This channel is here to track not just the headlines, but the rails being laid underneath them. The derivatives train is already leaving the station. The only real question is which networks it rides on.